I am going to tell you something that might seem contradictory. I have spent 75 years of my life picking individual stocks. I have built a $400 billion fortune by finding undervalued businesses and holding them for decades. I have dedicated my entire career to active investing. And yet, the advice I give to almost everyone, including my own family, is to ignore everything I do and buy a single index fund, just one fund. Hold it forever. Never sell. That is it. That is the secret to building wealth for 99% of investors. Today, I am going to explain exactly which index fund you should buy, why you should buy it, and how to use it to retire a millionaire, even if you are starting with almost nothing. Let me start by telling you what I have instructed the trustee of my estate to do with my wife's inheritance after I am gone. This is public information. I disclose it in my annual letter to shareholders. When I die, 90% of the cash will go into a low-cost S&P 500 index fund. 10% will go into short-term government bonds. That is the allocation, 90-10. S&P 500 index fund and treasuries. This is not theoretical advice. This is what I am doing with the wealth I am leaving to the person I care about most in the world. If it is good enough for my wife, it should be good enough for you. Now, you might ask, Warren, you own Berkshire Hathaway stock. You have made billions from Berkshire. Why are you not leaving Berkshire stock to your wife? Why an index fund instead? The answer is simple. Berkshire stock is a great investment if you understand the business, trust the management, and can hold through volatility. But my wife does not want to analyze businesses. She does not want to evaluate management. She does not want to worry about whether Greg Abel is doing a good job or whether the company is making smart capital allocation decisions. She wants simplicity. She wants to know that her money will grow steadily over time without requiring any effort or expertise. An S&P 500 index fund provides exactly that. It is the ultimate set it and forget it investment. The index fund I recommend is VOO. This is Vanguard's S&P 500 exchange traded fund. It tracks the S&P 500 index, which represents the 500 largest companies in America. When you own VOO, you own a tiny piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 other businesses. These are the companies that drive the American economy, the most profitable, most resilient, most innovative enterprises in the world, and you can own all of them with a single purchase. The current price of one share of VOO is around $567. If that seems expensive, do not worry. Most brokerages allow fractional shares. You can invest $50 or $500 or any amount and own a proportional piece of the fund. Here is what makes VOO so extraordinary. The expense ratio is 0.03%, 0.03%. That means for every $10,000 you invest, you pay $3 per year in fees. $3. I have spent decades looking for good deals, and this is one of the best deals I have ever seen. You get exposure to 500 of the best companies in America for essentially nothing. Compare this to actively managed mutual funds, which typically charge 1% to 2% per year on a $10,000 investment. That is $100 to $200 in annual fees. Over 30 or 40 years, the difference between 0.03% fees and 1% fees is hundreds of thousands of dollars, maybe millions. This is not a small difference. This is the difference between retiring comfortably and struggling financially. Let me show you the math. Assume you invest $10,000. You earn 9% annual returns, which is roughly the historical average for the S&P 500. You hold for 30 years with 0.03% fees in VOO. Your $10,000 grows to $128,000. With 1% fees in an actively managed fund, your $10,000 grows to $104,000. The difference is $24,000 just from fees. Now imagine you are investing more than $10,000. Imagine you are investing regularly over 30 years. The fee difference becomes enormous. You could lose $500,000 or more to fees over a lifetime. This is why I am so adamant about low-cost index funds. The fees matter. They matter more than almost anything else. Now, let me explain why I believe the S&P 500 is the right index to track. There are many indexes. The Dow Jones Industrial Average, which tracks 30 large companies. The NASDAQ, which is heavy on technology. The Russell 2000, which tracks small cap stocks. International indexes, bond indexes, real estate indexes. You could spend years studying all the different options, or you could just buy the S&P 500 and be done with it. The S&P 500 represents about 80% of the total U.S. stock market value. These are not small speculative companies. These are established giants, companies that have proven they can generate profits, survive recessions, and adapt to changing times. The S&P 500 is also self-cleansing. This is a critical feature that most people do not appreciate. The index is managed by a committee at S&P Dow Jones Indices. They decide which companies are included based on criteria like market capitalization, liquidity, and financial viability. When a company gets too small or goes bankrupt, it gets removed from the index. When a new company grows large enough and meets the criteria, it gets added. You do not have to do anything. The index automatically removes the losers and adds the winners. This is genius. You own the best companies at any given time without needing to make decisions. Think about what this means historically. In 1980, the largest company in the S&P 500 was IBM. Today it is Apple. In 2000, the top 5 companies were General Electric, Exxon, Pfizer, Citigroup, and Walmart. Today, the top 5 are Apple, Microsoft, Alphabet, which is Google, Amazon, and NVIDIA. The index adapted. You did not have to predict that Apple would become the most valuable company. You did not have to know that General Electric would decline. The index did it for you automatically. This is the power of passive investing. The index captures the winners without requiring you to identify them in advance. Now, let me address the most common objection I hear, Warren. If index funds are so great, why do you pick individual stocks? Why do you run Berkshire as an actively managed company? Why not just buy index funds yourself? This is a fair question. And the answer reveals an important truth about investing. What works for me does not work for most people. I have spent my entire adult life studying businesses. I read 500 pages a day. I understand accounting, corporate governance, competitive advantages, and management quality at a level that comes from decades of focused practice. This is my full-time job. This is what I am good at. Even with all that expertise and experience, I am competing against thousands of other smart people trying to beat the market, and most of them fail. Studies show that over 90% of actively managed large cap mutual funds underperform the S&P 500 over 15-year periods. 90%. These are professional investors with teams of analysts, access to company management, sophisticated computer models, and MBA degrees from the best schools, and they still cannot beat a simple index fund. If professionals with all those resources cannot beat the index, what makes you think you can? What makes you think I can consistently over my entire career? The honest answer is that I have been fortunate. I have had some skill, but I have also had luck and a long time horizon and the ability to stay rational when others panic. For the average investor who has a full-time job, a family, other responsibilities, trying to pick individual stocks is a mistake. You do not have the time to research properly. You do not have the emotional discipline to hold through volatility. You will make mistakes. You will buy high and sell low. You will chase performance. You will panic during crashes, and you will end up with worse returns than if you just bought an index fund and held it. This is not an insult. This is reality. Investing is hard, even for professionals. For amateurs, it is nearly impossible to consistently beat the market. I am often asked about my famous bet with Protégé Partners. In 2008, I made a public wager. I bet $1 million that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. Hedge funds are supposed to be the smartest investors in the world. They charge enormous fees, 2% of assets plus 20% of profits. They have access to strategies that regular investors cannot use: short selling, leverage, derivatives, private investments. They should be able to beat a simple index fund, right? Wrong. Protege Partners selected 5 funds of hedge funds. These funds invested in over 200 underlying hedge funds, the best of the best, the smartest investors with the most sophisticated strategies. I put my money in Vanguard's S&P 500 index fund. We let it ride for 10 years, from January of 2008 through December of 2017. The results were not even close. The S&P 500 fund returned 125.8%. The average of the 5 hedge funds returned 36.3%. The index fund nearly quadrupled the hedge fund returns, 125% versus 36% over 10 years. This was not a fluke. This was during a period that included the financial crisis, market volatility, a recession, everything that hedge funds are supposed to protect against. And they still lost badly. Why? Fees. The hedge funds were charging 2% plus 20% of profits. After fees, there was almost nothing left for investors. Meanwhile, the index fund charged 0.04% and delivered all the market gains minus that tiny fee. The lesson is clear. Low fees matter more than smart strategies. Simple beats complex over the long term. Now, let me tell you about the power of compounding with index funds. This is where the magic happens. When you own an index fund, you are not just benefiting from stock price appreciation, you are also benefiting from dividends being reinvested. The S&P 500 companies pay dividends, about 1.5 to 2% yield on average. That might not sound like much, but when those dividends are automatically reinvested to buy more shares, the compounding effect is powerful. Here is an example.
Let us say you invest $100,000 in VOO today. You hold for 30 years. You earn 9% annual returns, which includes both price appreciation and reinvested dividends.
After 30 years, your $100,000 becomes $1.3 million. $1.3 million from a single $100,000 investment. No additional contributions. Just buy and hold for 30 years. This is the power of compounding. Time does the work for you. But it gets better if you invest regularly. Let us say you start with $10,000, you add $500 per month. That is $6,000 per year. You do this for 30 years. You earn 9% annually. After 30 years, you have invested $190,000 of your own money. $10,000 initial plus $6,000 per year for 30 years. But your account is worth over $900,000, almost $1 million. You invested $190,000. Compounding turned it into $900,000. The market did most of the work. You just had to stay disciplined and keep investing. But this is why I tell young people to start investing as early as possible. The earlier you start, the more time compounding has to work. If you are 25 years old and you invest $10,000 in VOO today and never add another penny, that $10,000 will be worth $132,000 when you are 65. Just from that single $10,000 investment at age 25. If you wait until you are 35 to invest that same $10,000, it will only be worth $61,000 at age 65. You lose $71,000 by waiting 10 years. Time is more important than the amount you invest. Now let me talk about dollar cost averaging. This is the strategy of investing a fixed amount at regular intervals, regardless of what the market is doing. Every month, you invest $500 or $1,000 or whatever amount you can afford. Some months the market is up and you buy fewer shares. Some months the market is down and you buy more shares. Over time, you average out the price. This removes the need to time the market. You do not have to predict whether the market will go up or down next month. You just keep buying. Dollar cost averaging also forces discipline. When the market crashes and everyone is panicking, your automatic investment keeps going. You are buying at low prices when others are selling. When the market is soaring and everyone is euphoric, your investment keeps going. You are buying at high prices, but you do not care because you are in it for the long term. This consistent investing, regardless of market conditions, is one of the most powerful wealth-building strategies that exists. Let me give you a real example of why dollar cost averaging works so well. Imagine you started investing $500 per month in VOO at the beginning of 2008, right before the financial crisis. The worst possible timing, the market was about to crash 50%. Most people would say you got unlucky. But let us run the numbers. From January 2008 through December 2023, 15 years, you invested $90,000 total, $500 per month for 180 months. Despite starting right before the crash, your account would be worth about $260,000. You invested $90,000. You have $260,000. That is a gain of $170,000, nearly tripling your money even though you started at the worst possible time. Why did this work? Because during the crash, your monthly $500 bought more shares at lower prices. When the market was down 50%, your $500 bought twice as many shares. You were accumulating shares cheap. Then when the market recovered, those shares you bought cheap appreciated significantly. This is the beauty of dollar cost averaging. Bad timing does not matter if you keep investing consistently. Now let me address the biggest psychological challenge with index fund investing. Volatility. The market goes up and down. Some years it is up 30%. Some years it is down 20%. If you cannot handle watching your account value swing wildly, you will make mistakes. You will sell at the bottom. You will buy at the top. You will destroy your returns. This is where most investors fail, not because they picked the wrong investments, but because they could not control their emotions. I have lived through 14 major market crashes. I bought my first stock in 1942 during World War II. I have seen the market drop 50% or more on 6 different occasions. The 1973 to 74 bear market, Black Monday in 1987, the dot-com crash from 2000 to 2002, the financial crisis in 2008, the COVID crash in 2020. Each time, people panicked. They sold at the bottom. They swore off stocks forever, and they missed the recovery. Every single crash was followed by a new bull market that took the market to new highs. Every single time. If you had bought VOO at the peak in October of 2007, right before the financial crisis, and held it through the crash and recovery, you would have earned about 12% annualized returns through today. 12% per year, even though you bought at the absolute worst time and endured a 50% drawdown. How? Because you held, you did not sell. You stayed invested. The market recovered and continued higher. This is the most important lesson. Crashes are temporary. Recovery is permanent. If you give it enough time, let me tell you about the worst case scenario. What if you invested everything at the peak before the Great Depression in 1929? The market fell nearly 90% over the next 3 years. It took 25 years for the market to recover to its 1929 peak. This is the nightmare scenario, the worst market crash in history. But even then, if you had reinvested dividends and held, you would have recovered your losses within 15 years, not 25. And if you had kept investing during the crash and depression, buying shares at low prices, you would have made a fortune. The people who failed were the ones who sold at the bottom and never came back. The lesson is that you must stay invested through crashes. You must have the emotional fortitude to watch your account drop 30 or 40 or 50% and not sell. This is hard. I understand, but it is essential. If you cannot handle volatility, you should not be in stocks at all. But if you can accept short-term pain for long-term gain, index fund investing will make you wealthy over time. Now let me compare VOO to other investment options to show you why it is superior for most people. First, individual stocks. When you buy individual stocks, you are taking company-specific risk. The company could be mismanaged. It could be disrupted by a competitor. It could commit fraud. It could go bankrupt. If you own one stock and it goes to zero, you lose everything. If you own VOO and one company goes to zero, it represents 0.2% of your portfolio. You barely notice. Diversification protects you from catastrophic losses. Individual stocks also require constant monitoring. You need to read quarterly earnings reports, listen to conference calls, track industry trends, evaluate management decisions. This is a part-time job. Most people do not have the time or expertise. With VOO, you do nothing. The index automatically adjusts. You just hold and collect returns. Second, actively managed mutual funds. These charge high fees, 1 to 2% per year. The managers claim they can beat the market, but 90% of them fail over long periods. Even the ones that succeed in one period often fail in the next. Past performance does not predict future results. Why pay high fees for a 90% chance of underperformance? Just buy VOO and guarantee you will match the market minus 0.03% in fees. Matching the market beats 90% of professionals. That is an amazing outcome. Third, bonds. Bonds are safer than stocks. They have lower volatility, but they also have much lower returns. Over the past 100 years, stocks have returned about 10% annually. Bonds have returned about 5%. That 5% difference compounds to enormous amounts over decades. 100,000 invested in stocks at 10% for 30 years becomes 1.7 million. 100,000 invested in bonds at 5% becomes 430,000. You give up $1.3 million by choosing bonds over stocks. For young investors with decades until retirement, this is a huge mistake. Bonds belong in your portfolio as you approach retirement when you need stability. But for accumulation, stocks are far superior. Fourth, real estate. Real estate can be a good investment, but it requires active management. You have to find properties, negotiate purchases, deal with tenants, handle maintenance, pay property taxes. It is work. And it is illiquid. You cannot sell a rental property instantly if you need cash. Stocks are liquid. You can sell in seconds. Real estate also requires large capital. Buying a rental property might require $50,000 or $100,000 down payment. With stocks, you can start with $100. For most people, real estate is too complicated and capital intensive. Stocks are simpler. Fifth, cryptocurrency. I have been very public about my skepticism of crypto. I think it is worthless speculation. It produces no cash flows. It has no intrinsic value. The price is based entirely on finding a greater fool to buy at a higher price. This is not investing. This is gambling. Over the past 100 years, the stock market has compounded at about 10% annually because businesses generate profits. Those profits are returned to shareholders through dividends and buybacks or reinvested to grow the business. Crypto generates no profits. It just sits there. The only way you make money is if someone pays you more than you paid. That is not sustainable. Avoid crypto. Buy businesses. Buy VOO. Now let me talk about tax efficiency. VOO is extremely tax efficient. Because it is passively managed, there is very little turnover. The fund only buys or sells when the index composition changes. This happens infrequently. Low turnover means fewer capital gains distributions. Fewer capital gains means lower taxes. Actively managed funds have high turnover. Managers buy and sell constantly trying to beat the market. This generates capital gains. Those capital gains are passed to shareholders as taxable distributions. You pay taxes every year, even if you did not sell anything. This is a hidden cost. With VOO, you only pay taxes when you sell. And if you hold for more than 1 year, you pay long-term capital gains rates, which are lower than ordinary income rates. This tax efficiency adds to your returns over time. If you invest in a tax-advantaged account like a 401k or IRA, taxes are even less of an issue. In a 401k, you contribute pre-tax dollars. The money grows tax-deferred. You only pay taxes when you withdraw in retirement. In a Roth IRA, you contribute after-tax dollars. The money grows tax-free. You never pay taxes on the gains. If you can max out your 401k and IRA every year, do it. Invest everything in VOO or a similar S&P 500 index fund. Let it compound for decades. You will retire a millionaire. Let me give you a specific example of how powerful this is. Assume you are 30 years old. You max out your Roth IRA every year. The current limit is $7,000 per year. You invest it all in VOO. You earn 9% annually. You do this for 35 years until you are 65. You will have invested $245,000 total. $7,000 per year for 35 years. But your Roth IRA will be worth over $2 million. $2 million tax-free. You can withdraw it all in retirement and pay zero taxes. This is life-changing wealth from a very achievable savings rate. Now, let me address what you should not do with VOO. First, do not try to time the market. Do not sell when you think the market is too high and buy back when you think it is low. Market timing does not work. Studies show that missing the 10 best days in the market over 20 years reduces your returns by more than half. You cannot predict which days will be the best days. They often happen during volatile periods when you would be tempted to sell. Just stay invested all the time. Second, do not panic sell during crashes. This is the most common and most costly mistake. The market drops 20%. You get scared. You sell to protect what is left. Then the market recovers and you miss it. You lock in your losses and miss the gains. This is how people destroy wealth. When the market crashes, do nothing. Better yet, buy more. Crashes are sales. Everything is on discount. If you can stomach buying more during fear, you will be rewarded. Third, do not constantly check your account balance. If you check your balance every day, you will see lots of red days. The market is down more than it is up on any given day. This creates anxiety. It makes you want to sell. Instead, check once per quarter or once per year or never. As long as you are contributing regularly, you do not need to monitor it. The less you look, the less tempted you are to make emotional decisions. Fourth, do not get greedy and chase performance. When tech stocks are soaring, you will be tempted to dump VOO and buy a tech-focused fund. When value stocks are hot, you will want to switch to value. This is performance chasing. It always ends badly. You buy after the run-up, then that sector crashes. You lose money. Meanwhile, the S&P 500 keeps chugging along with balanced exposure. Stick with the plan. Do not chase. Let me share some historical perspective that should give you confidence in this approach. The S&P 500 has existed since 1926. Over those 98 years, it has delivered about 10% annualized returns, including dividends. There have been multiple periods of 10 or even 20 years where returns were below average. The 1970s, the 2000s. But over every 30-year period, returns have been solidly positive, about 10% annualized. This consistency over long periods is what you should count on. The American economy has grown for nearly 250 years through wars, depressions, recessions, technological changes, political upheaval. The economy keeps growing. Businesses keep innovating. Productivity keeps improving. And stock prices follow business fundamentals over time. As long as you believe that America will continue to grow and innovate, you should believe that the S&P 500 will continue to deliver positive returns over long periods. I believe this. I am willing to bet my wife's financial security on it. You should believe it too. Now, let me give you a simple action plan. If you take nothing else from this, do these things. 1, open a brokerage account. Vanguard, Fidelity, Schwab. Any major brokerage is fine. 2, set up automatic monthly investments, whatever amount you can afford. $500, $1,000, even $100. Just make it automatic so you do not have to think about it. 3, invest that money in VOO every month. 4, reinvest all dividends automatically. 5, never sell. Not during crashes, not during bull markets, not ever until you retire. 6, ignore the news, ignore market predictions, ignore pundits, just keep investing automatically. If you follow this plan for 30 or 40 years, you will be wealthy. Not rich overnight, not a billionaire, but comfortably wealthy, able to retire with dignity, able to live without financial stress. This is achievable for anyone with a middle-class income who starts early and stays disciplined. You do not need to be smart. You do not need to be lucky. You just need to be patient and consistent. Let me close with one final thought. I have been enormously fortunate in my career. I have made more money than I ever imagined possible. But if I were starting over today at age 25 with no money, I would not try to replicate what I did. I would not try to pick individual stocks. I would not try to find the next Coca-Cola or Apple. I would do something much simpler. I would invest every dollar I could into VOO. I would do it automatically every month. I would ignore volatility. I would let compounding work for 40 years, and I would retire a millionaire. That is the path I would follow. That is the path I recommend to you. Buy VOO, hold forever, get rich slowly. It is boring, it is simple, and it works. Let me tell you a story that illustrates the emotional challenge of index fund investing. I know a man named Robert. He was an engineer, smart guy, good income. He started investing in an S&P 500 index fund in 1995 when he was 40 years old. He put in $500 per month like clockwork. By 1999, after 4 years of contributions, he had about $35,000 invested. But the account was worth over $50,000 because the market had been strong. He was thrilled. He thought he was a genius for choosing index fund investing. Then 2000 happened, the dot-com crash. The market fell over 40% from peak to trough. Robert's account went from $50,000 to $30,000. He had invested $35,000 of his own money. The account was now worth less than what he put in. He was underwater. This scared him. He called me asking for advice. Should he sell and move to cash? Should he stop contributing? I told him no. Keep investing. This is when you should be buying more, not less. Stocks are on sale. He did not listen. He could not handle the emotional pain of watching his account decline every month. Robert stopped contributing in 2001. He did not sell everything, but he stopped adding new money. The market bottomed in 2002 and started recovering. By 2004, his account was back to break even, $50,000, the same as his peak. But if he had kept contributing during the crash, buying shares at low prices, his account would have been worth $70,000. He missed out on $20,000 by stopping his contributions at exactly the wrong time. This taught me that the emotional challenge of investing is harder than the intellectual challenge. Robert understood the math. He understood that buying low was good. But when it came time to actually do it, he could not. Fear took over. This is why so many investors fail, not because they pick bad investments, but because they cannot control their fear and greed. Let me give you another example. This one is even more painful. I knew a couple. I will call them Tom and Linda. They started investing in 2005. They put $1,000 per month into an S&P 500 index fund. They did this consistently for 3 years. By October of 2007, they had invested $36,000. Their account was worth about $48,000. They felt great. Then the financial crisis hit. The market crashed 50%. Their account went from $48,000 to $24,000. They panicked. In March of 2009, near the absolute bottom, they sold everything. They could not take the pain anymore. They moved to cash and swore off stocks forever. What happened next was devastating. The market recovered by 2012. The S&P was back above its 2007 peak. If Tom and Linda had just held, their $24,000 would have grown back to $50,000 by 2012. And if they had kept investing during the crash, buying at low prices, they would have had over $100,000 by 2012. Instead, they had their original $36,000 sitting in cash, earning almost nothing. They missed one of the greatest buying opportunities in history because they sold at the bottom. This mistake cost them hundreds of thousands of dollars over their lifetime. I tell this story to illustrate that the biggest risk in investing is not market crashes. The biggest risk is your own behavior. Now let me address a question I get frequently. What about international diversification? Should you own international stock index funds in addition to the S&P 500? My answer is that it is not necessary, but it is not harmful if you want to. The S&P 500 gives you global diversification, even though it only includes U.S. companies. Why? Because these companies generate significant revenue internationally. Apple sells iPhones in China and Europe. Microsoft sells software globally. Coca-Cola sells beverages in 200 countries. When you own the S&P 500, you are already exposed to global economic growth through these multinational companies. That said, if you want to add international exposure, a simple approach is to put 80% in VOO and 20% in VXUS, which is Vanguard's Total International Stock ETF. This gives you exposure to developed and emerging markets outside the U.S. The benefit is that you capture growth in economies that might outperform the U.S. The downside is that international markets have underperformed the U.S. significantly over the past 15 years. From 2010 through 2024, the S&P 500 returned about 13% annualized. International stocks returned about 6%. Holding international stocks hurt your returns. Will this continue? I do not know. Maybe international stocks will outperform in the next decade. Maybe not. If you want to hedge your bets, put some money in international. If you want to keep it simple, just own VOO. Let me also address bonds. I said earlier that my wife's allocation will be 90% stocks and 10% bonds. Why any bonds at all? Bonds provide stability. When stocks crash, bonds typically hold steady or even go up because investors flee to safety. If you have 100% stocks and the market crashes 50%, your portfolio falls 50%. That is terrifying. Most people cannot handle it. They sell. But if you have 90% stocks and 10% bonds and stocks crash 50%, your portfolio only falls 45%. The 10% in bonds cushions the blow. This makes it easier to stay invested emotionally. As you get older and approach retirement, you should increase your bond allocation. When you are 30 years old with 35 years until retirement, you can afford to be 100% stocks. You have time to recover from crashes. When you are 60 years old with 5 years until retirement, you cannot afford a 50% drop right before you retire. You need stability. A common rule is to subtract your age from 100 and invest that percentage in stocks. At age 30, you are 70% stocks. At age 60, you are 40% stocks. This gradually reduces risk as you approach retirement, but I think this rule is too conservative for most people. People are living longer. Retirement lasts longer. You need growth even in retirement. I would suggest being more aggressive. Even at age 60, you could be 70% stocks if you can handle volatility. Even at age 70, you could be 60% stocks. The key is to have enough in bonds to cover 5 to 10 years of living expenses. If stocks crash, you sell bonds to cover expenses and leave your stocks alone to recover. This lets you stay invested for growth while having safety for short-term needs. Let me give you a detailed retirement plan using only VOO and bonds. Assume you are 55 years old. You plan to retire at 67. That is 12 years. You currently have $500,000 saved. You contribute $1,000 per month. You earn 8% annually, which is conservative for stocks. At 67, you will have $1.6 million. Now, how do you manage this in retirement? You need $80,000 per year to live on. Social Security gives you $30,000. You need $50,000 from your portfolio. Here is the plan. Move 40% of your portfolio, $640,000, into bonds yielding 5%. This generates $32,000 per year in interest. Keep 60%, $960,000 in VOO. Between the bond interest and Social Security, you have $62,000. You only need to withdraw $18,000 from your stocks to reach $80,000 total. You are only withdrawing 1.9% from your stock portfolio annually. This is very sustainable. Your stocks can keep growing even while you are retired. If we assume VOO grows 7% per year and you withdraw 1.9%, your stock portfolio grows 5.1% net. After 10 years, your $960,000 in stocks has grown to $1.5 million even after withdrawals. Your total portfolio has grown even though you are spending from it. This is the power of staying invested in stocks even during retirement. You do not need to sell all your stocks and move to bonds. You just need enough bonds to provide stability and income while keeping the majority in stocks for growth. Let me also address what happens if you retire right before a crash. This is the nightmare scenario. You retire in 2007 with $1.6 million. You move 40% to bonds. You keep 60% in stocks. Then 2008 happens. Stocks crash 50%. Your stock portfolio goes from $960,000 to $480,000. Your bonds are fine at $640,000. Your total portfolio is now $1.12 million instead of $1.6 million. You lost $500,000. This is scary. What do? You do nothing with your stocks. You let them recover. You live off your bond interest and Social Security. If you need more, you sell some bonds, not stocks. Over the next 3 years, stocks recover. By 2012, your stock portfolio is back to $960,000. By 2015, it is over $1.2 million. You rode out the crash. You did not panic sell. You used your bonds as a buffer. And you came out fine. This is why I recommend keeping bonds in retirement. Not because bonds are great investments. They are not. But because they provide emotional stability, they give you cash to live on during stock market crashes. They prevent you from selling stocks at the bottom. This psychological benefit is worth the opportunity cost of lower returns from holding bonds instead of stocks. Now let me talk about inheritance and estate planning with index funds. When you die, your heirs inherit your investment accounts. If you have $1 million in VOO and you die, your heirs get that $1 million. Here is the beautiful part. They get a step up in cost basis. This means they inherit the shares at the current market value, not your original purchase price. All the capital gains you accumulated disappear. Your heirs can sell immediately and pay zero taxes, or they can hold and only pay taxes on future gains. This is an enormous tax advantage. It means you can hold VOO your entire life, never sell, never pay capital gains taxes, and pass it to your heirs tax-free. This is one of the best wealth transfer strategies that exists. Let me give you a specific example. You buy $10,000 of VOO at age 30. You hold for 50 years. It grows to 500,000. You never sell. You never pay taxes on the 490,000 in gains. You die. Your children inherit the 500,000 with a stepped-up basis. They can sell immediately and pay zero taxes on your 490,000 gain. They just save $100,000 in taxes. If they hold, they only pay taxes on future appreciation. This step up in basis is a huge benefit of buy and hold investing. You avoid all capital gains taxes by never selling. Your heirs get your wealth tax-free. This is very different from retirement accounts like 401k or traditional IRA. Those do not get a step up in basis. Your heirs inherit the account and have to pay ordinary income taxes on all withdrawals. If you have $1 million in a traditional IRA and die, your heirs must pay taxes when they withdraw. At a 40% tax rate, they only get $600,000 after taxes. With a taxable account holding index funds, they get the full $1 million tax-free. This is why I recommend maxing out your Roth IRA, which grows tax-free. Then investing in taxable accounts holding index funds rather than piling everything into traditional IRAs or 401k plans beyond the employer match. Let me close with the biggest lesson I have learned about investing. Simplicity beats complexity. Low cost beats high cost. Patience beats activity. These are not exciting lessons. They do not make good headlines. They do not sell books or newsletters. But they are true, and they work. I have spent my life looking for complicated edges, finding undervalued businesses that others missed, structuring creative deals, building a conglomerate. This worked for me, but it required full-time effort and skills that took decades to develop. For everyone else, the simple approach works better. Buy VOO, invest automatically every month, reinvest dividends, never sell, ignore the news, ignore predictions, ignore fear, ignore greed. Just keep buying and holding. Do this for 30 or 40 years and you will be wealthy. I guarantee it. I am 95 years old. I will not be around much longer. When I am gone, people will study my stock picks. They will analyze my acquisitions. They will write books about Berkshire Hathaway's success. But the most important investment advice I will leave behind is not about picking stocks. It is this: buy an S&P 500 index fund, hold it forever. That is it. That is all you need to know. Everything else is noise. Follow this advice and you will do better than 90% of investors. You will retire comfortably. You will leave wealth to your heirs. You will never worry about money. This is achievable for anyone with discipline. You do not need to be smart. You do not need to be lucky. You just need to buy VOO and hold. That is the secret. That is my final gift to you. Use it wisely. Before I finish, let me give you very specific practical advice on how to implement this strategy. This is the step-by-step plan that I would follow if I were starting today at age 25 with no money. First, get your employer match in your 401k. If your employer matches 50% up to 6% of salary, contribute at least 6%. This is free money. Take it. Invest the entire 401k in an S&P 500 index fund. Most plans offer one. If they offer a Vanguard or Fidelity S&P 500 fund, choose that. If they only offer expensive actively managed funds, choose the cheapest index fund available. Second, open a Roth IRA. You can contribute up to $7,000 per year. Do this every January if possible. Invest it all in VOO. The Roth IRA is the single best retirement account. Your contributions are after tax, but all future growth is tax-free forever. You never pay taxes on withdrawals in retirement. If you max out a Roth IRA from age 25 to 65, 40 years, contributing $7,000 per year, you will have invested $280,000 of your own money. But at 8% annual returns, your Roth will be worth $2.1 million tax-free. That is life-changing wealth. Third, if you have money left after maxing your 401k and Roth IRA, invest in a regular taxable brokerage account. Buy VOO. Yes, you will pay capital gains taxes eventually when you sell, but you get the step up in basis when you die. And you can control when you realize gains. If you have a low income year, you can sell some shares and pay low capital gains rates. If you have a high income year, you do not sell. This flexibility is valuable. Plus, dividends from index funds are mostly qualified dividends taxed at lower rates. The tax efficiency is good. Fourth, automate everything. Set up automatic transfers from your checking account to your investment accounts. Set up automatic purchases of VOO. You should never have to think about investing. It happens automatically every month. This removes emotion. It removes the temptation to time the market. It removes the possibility that you forget to invest. Automation is the key to consistency, and consistency is the key to wealth building. Fifth, increase your contributions every time you get a raise. If you get a 3% raise, increase your investment contributions by 1.5%. You still get to keep 1.5% for lifestyle inflation, but you are also accelerating your wealth building. Over a career, this makes an enormous difference. If you start investing 8% of a $50,000 salary, that is $4,000 per year. If you increase by 1.5% each year for 30 years as your salary grows, you will end up contributing over $20,000 per year by the end of your career. These increasing contributions supercharge your compounding. Let me show you how powerful this is with a real example. You are 25 years old. You earn $50,000 per year. You contribute 8%, which is $4,000 per year. Your salary grows 3% per year, which is typical. Every year, you increase your contribution rate by 1.5%. So year one, you contribute 8%. Year two, you contribute 9.5%. Year three, you contribute 11%, and so on. You keep doing this for 40 years until you retire at 65. You earn 8% annually on your investments in VOO. At 65, you will have approximately $5.2 million. $5.2 million. From a starting salary of $50,000 by consistently investing a growing percentage of your rising income. This is achievable. This is realistic. And this is how you become wealthy as a middle-class employee. Compare this to someone who just contributes 8% forever with no increases. Same starting salary, same salary growth, same investment returns, but they never increase their contribution percentage. After 40 years, they have $2.3 million. Still good, but less than half of what they could have had by increasing contributions with raises. The difference is $3 million. That is the power of increasing your savings rate over time. Now let me address the question of what to do with windfalls. You get a $10,000 bonus. You inherit $20,000 from a grandparent. You sell a car for $5,000. What should you do with this money? The answer is simple. Invest it immediately in VOO. Do not wait for a pullback. Do not try to time the market. Just invest it all at once. Studies show that lump sum investing beats dollar cost averaging about 2/3 of the time. Why? Because the market goes up more often than it goes down. If you wait and spread your investment over 12 months, hoping for a dip, the market usually keeps rising and you miss gains. Just invest it all immediately. But I also understand the emotional challenge of investing a large amount all at once. If you inherit $100,000 and invest it all today and the market crashes tomorrow, you will feel terrible. Rationally, you should not care because you are investing for the long term. But emotionally, it hurts. If you cannot stomach the idea of investing a lump sum immediately, here is a compromise. Divide the money into 3 or 4 parts. Invest 1/3 now. Invest 1/3 in 3 months. Invest 1/3 in 6 months. Invest the final third in 9 months. This gives you some dollar cost averaging while still getting most of your money invested relatively quickly. Let me tell you about the single biggest mistake I see investors make. They accumulate cash waiting for a crash to invest. They have 20,000 or 50,000 or 100,000 sitting in savings earning 3 or 4%. They are waiting for the market to drop 20% so they can buy cheap. But the market keeps going up 10%, 20%, 30%, and they are still waiting. Finally, the market crashes. They get their 20% pullback. But the market is still higher than when they started waiting. They would have been better off investing immediately and riding through the crash. This is why market timing does not work. You miss more gains waiting than you save by timing the entry. I knew a man who made this exact mistake. In 2012, he had 100,000 in cash. The S&P was around 1,400. He thought the market was too high after the rally from the financial crisis lows. He wanted to wait for a correction. The market kept rising. 1,500, 1,600, 1,800, 2,000. He was convinced a crash was coming. It had to crash. Valuations were too high. He waited through 2013, 2014, 2015, 2016. By early 2017, the market was at 2,300. He had been waiting for 5 years. Finally, in February of 2018, the market corrected 10%. It dropped to about 2,400. He invested his 100,000, thinking he was smart for waiting. But here's the math. If he had invested in 2012 at 1,400, his 100,000 would have been worth 170,000 by the time he actually invested in 2018 at 2,400. He lost $70,000 in gains by waiting 5 years. Yes, he avoided some volatility along the way. There were small corrections in 2015 and 2016, but the cost of waiting far exceeded any benefit. He would have been dramatically better off investing immediately in 2012 and ignoring the volatility. This story illustrates why time in the market beats timing the market. Always has, always will. Let me give you one more story. This one is about my own experience with Berkshire stock. Over the years, many people have asked me, Warren, should I wait to buy Berkshire stock until there is a correction? My answer is always the same.
If you want to own Berkshire, buy it today at the current price. Do not wait. Berkshire stock has compounded at about 20% annually for 60 years.
Yes, there have been bear markets where it fell 30 or 40%. But if you had waited for those pullbacks, you would have missed years of gains while waiting. Someone who bought Berkshire in 1965 at $15 per share and held has made over 50 million % returns. Someone who waited for pullbacks and tried to time their entry made far less, probably multiple orders of magnitude less. The lesson is clear. Buy quality, buy now, hold forever. Now let me address one final question. What about rebalancing? Should you sell some VOO when it gets too large as a percentage of your portfolio? My answer is that for most people, rebalancing is not necessary. If you own only VOO, there is nothing to rebalance. You just keep buying more VOO every month. The only rebalancing that makes sense is between stocks and bonds. If you have 90% stocks and 10% bonds, and stocks have a great year, you might end up with 95% stocks and 5% bonds. You could sell some stocks and buy bonds to get back to 90-10. This forces you to sell high and buy low. It maintains your risk level. This makes sense, but I would not rebalance frequently. Maybe once per year, or once every few years, or never until you retire. Rebalancing too often creates taxes and transaction costs. It also cuts into your compounding because you are selling your winners. If you rebalance from 95% stocks back to 90%, you are selling 5% of your stocks right when they've done well. Those stocks might keep going up. You are giving up future gains. There is a cost to rebalancing. For young investors far from retirement, I would not rebalance at all. Just let your stocks run. Add to bonds gradually as you approach retirement. But do not sell stocks to rebalance until you are within 5 or 10 years of retirement. In summary, here is your complete investment plan. Max out your 401k, max out your Roth IRA, invest any additional savings in a taxable account, Buy VOO in all accounts. Automate your contributions. Increase your savings rate when you get raises. Invest windfalls immediately. Never sell until retirement. When you approach retirement, gradually add bonds. In retirement, keep 60 to 70% in stocks. Live off bond interest and Social Security. Only sell stocks if necessary. Leave your wealth to your heirs with a stepped-up basis. That is it. That is the entire plan. It is simple, it is boring, and it will make you wealthy. Follow this plan and you will retire a millionaire. I guarantee it. And